You're listening to the Financial Source podcast, your daily dose of sentiment updates in the European and U.S. sessions and critical risk event previews so you stay up to date with what's moving the market right now. Each session is carefully crafted personally by the Financial Source analysts and voiced by our AI hosts who, as it turns out, sound a lot better than we do. Here's Rachel and Michael with this session's deep dive.
Welcome back to the Dip Dive. We're here to synthesize some really complex global sources for you. Everything from oil quotas to new political leaders. Our goal, give you that shortcut to, well, informed thinking. Today we're doing a pretty comprehensive briefing on the global landscape. Think currencies, commodities, trade, geopolitics. And the mission for you listening in is to really get the connections between those high-level political moves and, the immediate market impact. We're not just reading headlines here. We want to trace volatility right back to policy, back to uncertainty.
Absolutely. And that frame is so crucial right now.
Yeah.
Because policy shifts, political instability, these are really setting the tone globally, often more than the pure economic data, If you're wondering why the euro suddenly slipped or the yen's hitting new lows, the answer, it's probably not in the latest inflation print. It's more likely rooted in a cabinet shuffle or maybe an election surprise.
That's really clear in the currency markets, isn't it? Let's start in Asia. Japan's kind of setting the immediate FX tone. The ruling LDP chose Sanae Takaichi as leader, potential first female PM, and the market reaction, wow, it was instant. Massive.
Oh, completely decisive. Because her platform, it just signaled a really clear path, or divergence, I should say. Markets looked at it and thought, okay, near-term fiscal support, spending, stimulus, and crucially, patience on Bank of Japan normalization, like holding off on rate hikes. That policy mix, it's seen as inflationary and, pretty negative for the currency. Pushed the yen lower, steepened the domestic yield curve. Traders basically backed off expecting any big rate hikes soon.
Right, and those specific policy hints really drive home this growth-first bias you mentioned. She's talking targeted support, SMEs, agriculture, healthcare. But the market really seemed to key in on two things, possible fuel tax relief and leaving consumption tax cuts on the table. Why do those local things move a global currency so much?
Well, because they directly tie the BOJ's hands,
Yeah.
essentially. They reduce the central bank's ability to tighten policy. Any domestic help that props up growth or, shields consumers from higher prices, it just takes the pressure off the BOJ to step in with higher rates. We even heard, I think it was an external advisor, suggest Takaichi could maybe tolerate a single 25 basis point move by January, but explicitly not starting a full hiking cycle, just one and done, perhaps.
Okay. So the key takeaway for you listening is this political expectation. It means a weaker yen, wider rate differentials. That's what's keeping USD JPY up near those recent highs. It's a, perfect example of policy just trumping fundamentals.
Exactly. Now let's pivot over to Europe. The pressure on the euro, also pretty much political instability, purely that. The sudden resignation of Sébastien Lecornu, who was set to succeed French PM Gabriel Attal. That just threw fresh uncertainty into Paris.
And that political hiccup immediately hit that key risk gauge for the continent, didn't it?
It did. Straight away, we saw the OAT-Bund spread widen. That's the yield difference between French and German government bonds, the safe ones. When that spread widens, it means investors want a bigger risk premium to hold French debt. It signals, deep market jitters about French fiscal stability.
And that uncertainty fed right through to the currency. Euro-USD slipped below its 50-day moving average. It just shows how incredibly sensitive the euro is to domestic politics in, major players like France. This isn't just some local spat. It's really testing the Eurozone's fiscal coherence, fundamentally.
And if we just glance elsewhere quickly, sterling, softer against the dollar, but actually firmer versus the euro, mostly because all eyes are now on the UK's late November budget, what's coming down the pipe there. And meanwhile, down under, the RBNZ decision. That's setting the tone for a weaker KB dollar. Expectations of a lower OCR are building. It's really the same story everywhere. Politics and central bank anticipation driving currencies.
Okay, moving on from currencies. That same kind of macro caution seems to be anchoring commodities too. Let's start with oil.
OPEC Plus seemed pretty measured this week, right? 8 members agreed to a modest, 137,000 barrels per day increase for November. Very small.
Yeah, measured is the right word. It reinforced that steady hand narrative. No panic, but no big supply flood either. And producer pricing, backs this up. Saudi Aramco nudged its OSPs up slightly. Qatar set its differentials a bit above the benchmarks. It suggests they're managing supply carefully, trying to keep a floor under prices.
So producers are steady. What about the demand outlook? What's that doing to prices long term?
Well, the prevailing view, kind of the consensus, is that global consumption for 2025 might have already peaked, or is peaking. So that suggests Brent crude will probably stay stuck in a broad range, maybe $60 to $70 a barrel, anchored by, decent supply buffers and that general macro caution we've been talking about. It's a pretty tempered outlook. Doesn't leave much room for a big price spike, even with all the geopolitics swirling. Right.
Now, turning to metals, we saw that classic split, didn't we? Safe haven buying versus supply-side drama in base metals. Gold hit fresh records, around $3,950 an ounce. Driven by exactly the fiscal and political risks we've discussed, classic flight to safety.
Definitely. But base metals, especially copper, were choppy. And the real driver there, supply-side issues. Big ones in Indonesia. There was a crackdown on illegal mining, and the government handed over seized tin smelters to the state-owned miner, PT Timah. Now, this isn't just, local bureaucracy. Indonesia is the world's second biggest tin producer. So this regulatory shift, it's a massive physical supply bottleneck, creates real-time pressure on global electronics manufacturing. Tin's crucial there.
And what's fascinating is how analysts seem to be contradicting each other on the long-term view here. Exactly. We saw one big bank say short December 2026 aluminum, citing valuation concerns. But then, in the very same report, they lifted their long-run copper forecasts. Why? Because they expect tighter supply later this decade. So for you listening, trying to figure out a long-term strategy, this kind of contradiction, it suggests structural volatility driven by supply shocks and regulation, is just, well, it's the new normal for metals.
Okay, let's shift to an area where policy is really fundamentally reshaping things, strategic trade. We're seeing major blocs actively using industrial policy to, rely less on rivals, moving beyond just tariffs to actual strategic positioning.
Yeah, it's all about securing tech sovereignty, controlling critical manufacturing, that kind of thing. Look at Europe. Brussels is pushing this big AI strategy, and it's specifically designed to cut reliance on U.S. and Chinese tech. It's like Europe is building a kind of digital firewall, trying to reshape data standards, tech flows, based on its own interests.
And in Asia, they're tightening rules too, but more in response to supply and capacity pressures, right? Tokyo's widening its anti-dumping net, trying to catch indirect shipments goods routed through third countries.
Exactly. It's a direct, very calculated response to China's overcapacity spilling over and hitting Japanese industries. They're basically tightening the screws on who they trade with and how that trade happens.
And we see that same sort of defensive posture in North America with the nearshoring push.
Mexico's President, Claudia Sheinbaum, was pretty direct in her messaging recently. She highlighted progress they expect on domestic EVs, semiconductors, even satellites and drones. Her goal seemed clear: signal confidence in, continued good trade terms with the U.S. And by doing that, anchor that crucial supply chain investment in Mexico, stop it from going elsewhere.
All right, geopolitics. Still the underlying engine of volatility for markets, wouldn't you say? In the Middle East, some critical developments we need to watch. Israel and Hamas are apparently slated for mediated talks in Egypt, and Washington called the hostage release prospects the most advanced in some time. That sounds potentially significant.
It does sound hopeful, yes.
Yeah.
But, we have to stress the caveats here. They really temper that optimism. Israeli officials are making it clear no formal ceasefire is in place. Gaza City is still very much a combat zone. And while things like a staged withdrawal line, a framework for exchanges, while those ideas have been floated, the timelines seem incredibly fragile, highly contingent on technical progress that, could just unravel very quickly.
Okay, shifting to Eastern Europe, intensity still high there. Russia launched large-scale strikes across Ukraine, targeting defense industry, energy assets, and reporting some incremental gains in Donetsk. Kyiv, meanwhile, cited significant damage in several regions overnight.
And this immediately plays into those sensitive U.S.-Russia dynamics. Moscow warned that sending Tomahawks to Ukraine would erode ties further, even while, interestingly, the Kremlin called Washington's latest words on nuclear limits a mild positive. It signals this ongoing, very tense, but also kind of nuanced dialogue happening behind the scenes. Investors really need to track that for any sign of escalation or maybe de-escalation.
And finally, just quickly touching on other strategic moves, the U.S. is lobbying hard against a UN resolution on the Cuba embargo and explicitly linking Havana to supporting Russia's military. That raises the stakes diplomatically in the region.
Over in Asia, North Korea is allocating strategic assets, setting the U.S. force posture, pursuing more military steps. On a different note, Indonesia lifted its suspension of TikTok's license, but only after getting the data it wanted. It signals that regulatory compliance, data sovereignty, these are becoming huge negotiating points for Western tech platforms in Asia.
And of course, Tokyo and Washington are gearing up for a leaders summit late this month. That'll be key for watching alliance coordination, especially with all these regional tensions. We really need to spend a moment just on the U.S. itself. Political gridlock there continues to impact growth forecasts. The federal government is still shut down. The administration's even warning about potential layoffs for federal workers if talks don't progress. That's not just theoretical, right? The threat of mass federal layoffs directly hits growth outlooks, consumer confidence.
Yeah. And that difficult fiscal backdrop is complicated by other pressures, like on growth. The White House recently floated some measures trying to speed up home building, pushing the GSEs, Fannie Mae, and Freddie Mac and developers. They're essentially trying to use these huge entities to boost housing supply, kind of bypassing Congress.
Which is a direct response to trying to ease housing pressures, right? Which feeds straight into inflation worries. And the fact they're using these administrative, non-legislative tools. Well, it just highlights the paralysis in Congress, doesn't it?
It really does. And the final layer of complexity here. The president authorized National Guard deployments amid these legal fights over federal authority in several states. Now, that might seem localized, but this tension between state and federal power, it just adds another layer of policy uncertainty, potential disruption. It really compounds the effect of the shutdown. Political stability, or maybe the lack of it, is driving the narrative here at home just as much as it is abroad. Hashtag outro. So if we wrap this all up, look back at the sources, what should you really be tracking tomorrow, next week? I'd say 4 key things. First, the yen. Its continued policy-driven path after that political shift in Japan. Keep watching that. Second, the euro's sensitivity. Look at that OAT-Bund spread. It really shows the deep link to French political stability. Third, the oil market. That tempered supply outlook seems to be keeping Brent pretty well anchored for now. And fourth, any actual concrete, verifiable progress in those Middle East talks, that remains, I think, the single biggest geopolitical tail risk out there.
Yeah, and here's where it all connects, right? Think about the irony. We started this deep dive talking about how just the prospect of domestic fuel tax relief in Japan, a really local policy idea for small businesses, immediately weakened a major global currency. It just underscores how immediately interconnected these global policy risks are becoming, even when they start from something very local, very specific politically. So we'll leave you with this final thought to chew on. If political stability, or the lack of it, is now consistently the main instantaneous driver for huge currencies like the yen and the euro, what traditional economic indicators are we maybe fundamentally underweighting when we assess global risk? Perhaps it's time to shift focus, not just reading the GDP reports, but really digging into understanding the political tea leaves. Thanks for diving deep with us.
Thanks for listening to the Financial Source podcast. If this podcast helped you at all today, would you consider leaving us a review to help spread the word? Each month, we also give away different resources and indicators just to podcast listeners. So write into Financial Source at support@financialsource.co to claim your free gift today. Talk to you all in the next episode.